It's been 1 year since restless individual traders, shaken by the coronavirus pandemic, started what they thought would be a revolution against Wall Street. Most people remember it as the story of small investors banding together to beat the street and make huge profits. But that's not exactly what happened. The truth is, the meme stock craze and the band of angry Reddit traders brought the hedge funds, big banks, and professional money managers a big payday. But the story doesn't end there. The battle for the soul of the stock market and the future of investing, that's still going on. I'm gonna explain how the so-called revolution really lined Wall Street's pockets, how the market has changed since January 2021, and what the new world of investing means for the stock market going forward. We're gonna dig into all that, but first, let me remind you of how we got here. Billed as the finance world's David versus Goliath, most people first started hearing about meme stocks in January 2021 as GameStop stock started taking off. The army of traders who had gathered on the Wall Street Bets subreddit had discovered something of a cheat code. They identified and bought stocks with high levels of short interest that hedge funds were lining up to bet would fail. GameStop was one of the main stocks the subreddit had identified at the time. It had been rising steadily through 2020 as the overall market recovered. But during the month of January 2021, the stock's price rose by 1,600%. For the hedge funds, there were some big losses. Melvin Capital, a hedge fund with $12.5 billion in assets last January, lost more than half of its clients' money short selling GameStop. The company had huge uncovered bets that GameStop stock would fall in price. Then, on January 28th, Robinhood and many of the most popular retail trading brokerages announced they would halt buying in GameStop and several other stocks that retail had been buying. That seemed to change everything. Furious retail traders blamed Robinhood and a cabal of hedge funds, politicians, and money managers for conspiring to stick it to the little guy. This is the part of the story where most people stop paying attention, but it's where the real story of the retail trading revolution begins.
They thought that they'd found a great money-making scheme and a way to blow multi-billion-dollar holes in some of the biggest funds on Wall Street.
My colleague Spencer Jacob, who edits WSJ's Heard on the Street column, wrote a book called The Revolution That Wasn't.
That just isn't what happened. They mostly did not make money, and they poured a lot of money into Wall Street's pocket.
The retail trading bonanza led to record profits for firms like Goldman Sachs and Morgan Stanley. Even Robinhood raked in massive gains. How did this happen? Traders were buying options and buying and selling stocks multiple times a day. Every trade that's made is routed through a market maker that pays brokerage firms a fee. This is how companies like Robinhood, that don't charge users a direct fee for trading, make their money. Companies like Citadel Securities are the market makers. They take a fraction of the cost of the trade and they pocket that. It's a tiny percentage of a cent, but when there are millions of trades happening every hour, that adds up to a lot of money at the end of the day. More trades also means more money flowing through investment banks like Goldman, JP Morgan, and Deutsche Bank. And while Melvin Capital and a few others suffered, most hedge funds did very, very well. Many retail traders did pretty well too.
But eventually the whole thing fell apart. Between January 28th and a week later, GameStop lost almost 90% of its value.
But the story isn't over. Many retail traders were first drawn to trading by the craze in meme stocks. Now they're driving a few big changes to the way the stock market operates. Perhaps the biggest we've seen is the growth in options trading, which reached record levels in 2021, thanks to a huge increase in activity from retail. Analysts say this has been a big driver of stock prices. Retail used to just be along for the ride, while big institutions and hedge funds drove the market. That's changing.
We've almost seen like a confidence shift.
Callie Cox, a market analyst at eToro, has been keeping a close eye on what's happening.
Retail investors kind of know their power. They know their voice. They know that they're able to move markets and community. They know how these markets work. They know that, the Fed is really engaged right now. And they've seen a market that, basically rewards those who kind of stay in it.
The surge in trading by everyday investors and the meme stock revolution have even gotten lawmakers and regulators to look into issues that some retail traders have been screaming about for years. All this attention was the result of these headlines, but also the fact that retail traders are becoming too large to ignore. JP Morgan estimates that individual traders have accounted for over a third of stock market trading several times over the past 18 months. They made up 40% of the trading on peak days. And retail bought 7 times more stocks in 2021 than they did in 2019. Young people are getting more involved in the markets, and that trend doesn't look like it's going to stop. 6 in 10 people between the ages of 25 and 34 said they put more money in investments over the last year. This has made Wall Street's professional class a little nervous about getting burned again. According to a recent survey, 85% of hedge funds and 42% of professional asset managers are now tracking retail trading message boards. So while the big banks, corporations, and wealthy financiers may have won the first round, it's clear that the Reddit revolution has made its mark. The big question is, what's next? Retail traders are showing no signs of taking their ball and going home. So far, these traders seem interested in risky bets like options, high-flying stocks, and cryptocurrencies. But data also show that retail traders are buying old-fashioned index funds and blue-chip companies like Apple and Microsoft. That shows that retail traders are taking more risk, but they're also becoming more practical investors who are thinking about investing for the long term. One big difference has been a lack of fear.
Before the great financial crisis, retail was kind of seen as the money, the dumb money. The money that would sell quickly once something went wrong.
Today's retail trader is seeing that when prices fall, it's not a time to be fearful and hide. It's time to buy the dip. Retail's top 8 buying days have all come when the S&P 500 was down by at least 1.3%. Traditional Wall Street has been redefined in recent years by high-frequency trading, algorithms, and artificial intelligence. It's now being upended by individual traders who have some new ideas about how to buy and sell. It remains to be seen how this new force will respond when stock prices fall and stay down, and what that will mean for the market and the economy. If you enjoyed this video, hit the like button. And if you're interested in markets and want to watch and learn more, subscribe to this channel to keep up with my latest. In the words of Brooklyn legend Fabulous, respect ain't earned twice. Once you lose it, it's gone. And it's lame when your money's right, but you're using it wrong. That's it for now. I'll see you next time.